Hello and welcome to the first of a two-part webinar series on PRA 110 by AMIS International. On today's webinar we have Joe DeRollo, CEO, Simon Garrett, Head of Implementations, Matt Poole, Financial Systems Analyst, and myself, Georgina MacLeod, Financial Systems Analyst. In today's webinar, Joe will be given an overview of the PRA 110. Matt will go on to discuss the data from your core systems, how they can be imported into AMIS for use with the report updates. Simon will be going over how to update the reports with a look particularly at savings deposits and how we populate those into the liquidity reports in AMIS. Then we'll be going on and a general discussion of some points of interest that we've had over the PRA 110. So we'll be looking at some specific points regarding interpretation. We'll have some time for a Q&A session as well towards the end before we wrap up and just discuss the next webinar on this series.
Okay, well, thank you very much, Georgina. Welcome, everyone. So the PRA 110 is, as I think everyone will be aware, an extremely large report. What we can see on the screen there is the entirety of it. What is in green is the C66, which in some ways is its predecessor, and the PRA have added to the C66 to make it more granular. To put that in context, the C66, so what's in green, was previously the largest regulatory report of all regulatory reports. So we can really see how much bigger the PRA 110 is in terms of data points and so on and so forth. What we're going to focus on today is the first three sections, the outflow, inflow and counterparty sections. So that just makes it a little bit more tangible, get our heads around. In some ways, what we're covering today is how to complete the contractual cash flows, the contractual inflows, outflows and counterbalancing sections. That can all be done from source data, or should be able to be done from source data. So what our aim is today is to help our customers use AMIS software to produce these three sections and get on with the job of getting those three sections completed using AMIS software, so that it's all done as automatically as possible. This report has to be done for most of us on a monthly basis with a 15-day turnaround, so has to be completed reasonably quickly. The contractual outflows, contractual inflows, one minus the other gives the net funding gap. The counterbalancing section can be in some ways a repetition of the asset side. It's the assets that are available if we're to sell them to fund that gap. So what's our sort of resources that are available to fund our net funding gap, but all done on a contractual basis. In terms of our implementation process, really there are essentially three elements of data that we need to populate these reports. And in terms of going through a process for populating the reports, our implementation process, or customers that are just wanting to update the liquidity module, so on and so forth, it's useful to do that in data section by data section. So we start with the savings and deposits data and complete the reports, make sure it's all reconciled for that data set, then deal with your treasury data, maybe treasury liabilities potentially, and treasury assets, and maybe as a next type of data, as lending data, to complete that part. So we tend to sort of do the project implementation in three sections: deposit data, treasury data, and lending data. If you've already implemented in ALMIS the FSA 4748, then building up to the LCR is a relatively straightforward process. And if you've already got the LCR, building up to the PRA 110 is a relatively straightforward process. In fact, should be an extremely straightforward process. What we're endeavouring to do is incremental implementation. So this has an advantage to clients who have already got the FSA 4748 going. So for example, if you've coded your Bank of England reserve account to FSA 4748 code 19, then it will immediately know that it's a central bank reserve account and populate the appropriate lines in the LCR and PRA 110. Those that are only implementing now for the first time without the 4748 and so on have to bear with us a little bit in some of the coding has got sort of legacy coding to it. In terms of another cut of that information, as far as the PRA 110 is concerned, the deposit or savings data is really concerned with section 1.3. The treasury data, a lot more sections, although probably less data elements, and the lending is a couple of sections, both inflows and counterbalancing capacity. Whilst deposits is just one section, really, in terms of the first three main sections, it's just one part of it, 1.3. It is probably the most important thing to concentrate on for this report, for most of us, certainly for retail institutions. So we'll spend quite a bit of time today going through the savings data, the deposits data. Just very high level, you're all familiar with ALMIS. There's a number of data elements that we are needing to get from different categories of deposit data. Key to this is the product code definition, our accounts definite, what is the account details, the product type details, and the second is the customer dimension, what are the customer details. So we have a dedicated product code and a separate dedicated customer code. We'll come back to that. In terms of the account level detail, we need the balance, both the amount that's owed and the interest balance, as well as the amount of that balance that is guaranteed. So from the core system, there usually has to be some sort of transformation. This will be done more automatically for you in our new Middle Office Plus product, but at the moment with ALMIS, that has to be done from your core system to determine from all the account balances how much of that is guaranteed. It's key data for these liquidity reports. And obviously the maturity date, the earliest maturity of our products needs to be populated in the contractual maturity days field. So a number of, that's the sort of data elements that go in. I won't dwell too much on that. The key thing that we need to input there is a product definition. In terms of the product definitions that we've got, we are combining some of the codes there. There's important fields are whether it's non-defined maturity. There's a specific, in the way ALMIS has been developed, is deposit data is typically retail data, but we do recognize that some deposit data that's coming through is non-retail, and so the sector differentiation we've done at the product code level within ALMIS, although strictly speaking it's a customer type definition, but there will be a need to define at the product level if you've got non-retail deposits. And not operational, non-operational deposits, and so on and so forth, all sort of for the purposes of reporting. And then we have customer definitions. specific customer definitions. These are very high level, and Matt is going to go a bit more detail about it. But we want for every, we don't want to know for every account who the customer is. What we do want to know for every account is the type of customer. Is that customer a high balance customer? Is it an established relationship customer? Is it a non-resident customer? And so on. So those things need to be determined as the data's sort of being extracted, etc., for grouping to the account level data for different types of customer. On the treasury side, our philosophy within Almus is the treasury data. It captures slightly different data elements to deposit data and lending data, and so we have different sort of data tables. The treasury data has things recognizing that these securities can be traded and so on and so forth, or sold, purchased at a discount or premium, have a market value, and so on. So we do capture slightly different data elements, but fundamentally we've got the same. We are still capturing the product definition or the instrument definition for each treasury trade, and also the customer definition for treasury items. That customer definition is held at an individual counterparty level. So the various inputs for product definitions for treasury. One thing that we will be changing in our Middle Office Plus product is that treasury trades, the collateral and the issuance will be separate dimension tables. At the moment, they are all really combined into the instrument definition. So if you have repo funding with different types of collateral, you have to set them all up as different instruments, whereas a single repo instrument could have, depending on the type of collateral, kind of different collateral in the way that Middle Office Plus will be set up, as the collateral will be a distinct sort of field. But currently, collateral and the instrument definition are all contained in the same definition. Okay. And the individual counterparty details for each individual treasury counterparty has to be populated, and the sectors in there, and so on and so forth. Great, so that's just a high-level overview of how the sort of data is set up, and the main things to concentrate. The first thing to do, obviously, is to get that data in, and we've developed a number of tools and systems to help sort of populate, particularly the customer codes and the product codes, which Matt is going to help us with.
Thanks, Joe. So I'm going to predominantly focus on the savings data requirements. Joe's already covered kind of the main elements that you're probably already capturing when you do your savings data load. And he has also touched on things like the customer code and the product code requirements. But for the purposes of liquidity reporting, which, and specifically the PRA 110 and the LCR, we do need to capture some additional characteristics. So the Delegated Act requires us to capture, if at a customer level, if the customer is a high balance, if they're the resident of their third country, and if they're an established customer. We also, there's product elements, and Joe's mentioned that the LCR code, which captures the sectors currently in Alma, is captured at a product level, so we also need to be able to identify that. So other things that are product characteristics are things like if the account's only serviced on the internet, if the account was a Best Buy product, and if the account is like an indexed linked account. The purposes of identifying these is these are all need to be given higher risk weightings, which Simon's going to cover on later in the presentation. Firstly, all of our documentation covering the data requirements and the setup and the settings that you can use are all in our client area, specifically the standard savings interface. It covers things like the guaranteed balance, the treatment for notice given, and how you can compress your data. So firstly, a lot of you will be familiar with our standard savings interface, but I want to focus on 6 fields. So there's the customer code field, which is field 13, and then we have SAV code fields, which are fields 18 to 22. And what we need to do is to autopop and for Almis to create your customer codes for you, we need to capture in these fields the additional data elements that I've gone over on the previous slides. So things like if it's high balance and so on. And what Almis will do at import is it will concatenate the specified fields that you've populated and create customer codes, which we can then use in the system and assign risk weightings and countries and etc., which I'll cover in a later slide. It's important to note that we don't need to use all of these columns, so we can use just customer code and just SAV code 1. In my example, I just used the first 4 SAV codes. So in this example, I've used the first 4. So what I've done is in my SSI upload file, I populated those columns with established, non-established in my first code. So that's capturing that data element at a record level. I've got if it's a low balance or a high balance in the second column. Third column if they're resident or non-resident. And then in the blue column, I've captured if I've got any deposits that are non-retail deposits. That's something else I'd want to capture at a data level. So on this example, most of the deposits are retail. There's one that's non-operational financial and one operational deposits. So I've captured that as well and put it into one of the SAV codes. And I'll explain later how I can use that. So once you've captured your the additional data elements in your SSI file, you need to tell Almis which columns that you put those in and in which order which order you want to concatenate them. So we do this via an Armis ini setting. So we need to add to your Armis ini, which is stored in your server data folder, this customer type code equals. And what that's doing is it's counting the columns, so columns 18 to 20 in this case, and telling the system I want to create my customer codes from those columns. So Almis will concatenate, depending on what data you've got in your file, all the combination customer codes. Once the savings file is loaded in, it will add the selection of customer codes it's created to your standard savings customer code ledger, which is found under your import ledgers in middle office. And this allows you to shorten them. So where I've used EST and NEST in my SAV code 1, I could have used established, non-established, and it would have been a lot longer. So using this ledger lets us shorten the codes down, and also sort of map 2 to 1, many to 1 if we require. We don't require every single combination of customer code. We can map them, we can reduce the number using this ledger. Once you've completed the Almis code column of the ledger, you can reload in your savings file, and then all the records will come into the system with the Almis code populated into the customer code field of your data. So once your customer codes are populated into the system, there is a customer code table that's available from the file menu in middle office, as you can see on the right hand side of the screen. This lets you set the characteristics for the customer, for the group of the customers, customer type. So things like the economic sector, the country, and perhaps most importantly, if it's an established relationship or not. Which from the customer codes that I've created is very straightforward to see, because it's just the whether it starts EST. So you can see I've assigned those established in the table. So that'll be used for the liquidity and LCR and PRA 110 purposes. So now, let me cover off the product code concatenation tool as well. What I've not used SAV code 4, which I identified at the start of the slides. What I need to do is, if you've got non-retail deposits, we need to currently capture at a product level which of the product codes are to non-retail customers. So in my example, I want to concatenate the product code field with the SAV code 4 field at import. So to do this, we've got an RMS ini setting which works in a very similar way to the customer code. This time we add savings product code equals to the RMS ini setting. What this will do, in the same way, it will concatenate your product code with your SAV code and add it to the standard savings ledger. Here you can map that to an ALMIS product code and make it to a shorter code if required. Now you will have all your product codes identifiable by what sector the deposits are held, which allows us to assign an LCR code, whether it's retail, non-operational, etc., which is all the information we need to capture and populate the liquidity reports.
Yeah, thanks very much, Matt. Just to summarise then, I think in terms of populating product codes and customer codes, there are tools to concatenate and map your data from your source system to get the appropriate level of granularity that's needed to calculate these reports. So there's quite a lot of flexibility there based on how you're going to get data from your source systems. And Matt's just gone through sort of how to do all of that, which is also sort of documented. So now Simon can just take us through what it all looks like once you've got the system up and running.
Yeah, thanks, Joe, and thanks, Matt. Before I go on to that configuration, I think what you'll see, and again from what Matt has shown us, is what we've tried to do is make that import of data as flexible as we can, so that we can accommodate all those factors that we need for the LCR into your data import. So again, giving you the flexibility of you defining exactly what goes into each of those savings codes to then bring together what is the customer code, again, that's used for the LCR. And again, with the guidance around what we're actually trying to do around meeting the requirements of the Delegated Act, then those key attributes then are easy to capture within your source data, concatenate, and then bring it into ALMIS. So what I'm going to do now is I'm going to build off the back of those customer codes that Matt has alluded to in terms of populating the data set that we have here. I'm just going to show you how those liquidity rules are defined and show you some of the rules that we've defined within the setup here. And also look at all the associated reports that are building from that configuration. And again, taking Joe's point earlier is in terms of the way that we built on the existing coding of the likes of the 47, 48, through to the LCR, the 66, and ultimately the 110. And again, it's making that, utilising that same code then to enable the population and ultimately auto-population of those associated regulatory reports. Okay, so in the ALMIS setup as we have here, is what I'm going to do is I'm just going to go through the update routine and then just show you how those reports are actually configured, the liquidity rules are assigned, and look at those associated reports. So under the update menu, we look at the update of the market value gap report, and what you'll see towards the bottom is the liquidity coverage and the stable funding defined where we actually define these rules. So the first thing I'm going to do is look at the actual risk factor table. So the risk factor table denotes where all these existing rules, what the rules are within our data that we want to expose for the LCR. So what we'll see here is the rules that have already been established that are building on the high balance, internet only characteristics, non-established characteristics, and notice given. And it's looking at basically the columns then of defining whether it's what the product code, what the product category is, the customer code, the guaranteed portion of the balance, whether we want to include the whole balance or whether we want to include the non-insured, excuse me, the non-insured element, the maturity matrix, maturity transformation date, and also then the stable funding factors. So if we were to add those for the first time, what we'll do here is we'll actually add a new rule. So what this is pulling out now is the ability to look at those two elements, those two characteristics we were talking about before, the product characteristic and also then the customer characteristic, the customer code. So what we have to do here is we'll define a rule, and here I'll just define a rule and we'll call this non-resident because we haven't got a non-resident rule established at the moment. Okay, so we have a non-resident narrative set up for this particular rule. Now what I've got to decide now is, does this apply to all products or is it specific product attributes that we're looking to assign this rule to? So here we can click on all because this is a customer attribute. It doesn't matter what type of product the customer has. It's a rule that we want to expose whether they're a resident or a non-resident, non-EU or EU resident. So by selecting all here, what we're then left with now is defining the type of customer. So what type of customer do we want to expose here? Well, we're just looking purely at the non-residents. So again, building on what Matt was saying, there's a way we've actually concatenated or grouped together that customer code. I can see now that I have a non-resident, another non-resident, another non-resident. So I have 4 non-resident categories that are established within that customer code composition. For the purpose of what I'm doing here, do I want to include all the balance? Do I want to include the guaranteed as well as the non-guaranteed or the insured or non-insured element? So at this point we'll say yes, I want to include the whole balance in this case. I've got to then assign the maturity date, so whether I want to look at what's within the LCR window, which we'll do here, and assign that as 30 days. But it doesn't stop you actually applying any outflows to products that are beyond that 30-day window by extending this maturity date profile we have here. The next thing is a risk factor. So these risk factors, if we take ourselves back to the Delegated Act, what we're trying to do here is collect risk factors that are associated with a customer, a product, or a combination of customer and product, and then look at the actual risk factor that's assigned to them. So if we look at what is a high risk, we have high risk and very high risk with the two elements, the two outflows that we want to expose, and attach different outflow percentages too. So if we think about the high risk or the high outflows, we want to say is it's going to have 2 risk factors. It's going to score 2 points, if you will. Now that can be purely a high balance, or it could be a combination of any other two other factors that gives it a score of 2. So what we're saying here is high balance would automatically go into a high risk category. And then if they are both high balance and non-established or non-resident or internet, they would have in effect score 3 points. 3 points then takes you to very high risk. And that's the methodology that we're looking to do within ALMIS, is to look at the way that we're assigning those risk factors, collecting and counting those risk factors together to give us the output then that we're actually going to populate the respective lines in the LCR. You'll notice one other element here in the rule that's been set up in the background is we have a notice given. Again, where we have notice has been served and that outflow is due within the next 30 days. We have to through the Delegated Act, assign 100% outflow to that particular balance, the balance on which notice has actually been served. So what we're doing here is we're actually throwing this out and putting this as a very, very high risk number of 9. And I'll show you how we actually group these and assign what we call the risk levels that are attributed to these loans. So non-resident in its own right is just a single risk factor. Once we select done on here, that is then going to update and create the rule for us. Okay, so that's then going to create, you can see at the bottom what it's now done is it's created 4 new rules. It's exposing the non-resident, the non-resident customer applying to all our product codes, including the guaranteed balance and then the stable factors. If I now look at the risk levels, so this is the point we were looking into grouping those risk factors together to work out what is high risk and what is very high risk. So we can see here that if anything scores more than 1.9, it's going to go into category 1, the high risk. And I'll show you in a second how we then assign the associated outflows against that high risk. You've then got anything that scores more than 2.9, so 3 and above, it's going to go to the very high risk, and again that notice given element that is going to throw us into category 3 within the LCR. So once we've actually created those rules, we've looked at grouping them together, what we'll do then is just run that LCR and look at how it actually populates the ALMIS LCR report. What we'll do before I go through and show you the report, there's other elements that we need to look at here within the configuration of our LCR. If we look at the inflow and outflow percentages, so here we are configuring, giving you the ability to look at your individual inflows and outflows percentages based off category 1, category 2, which are defined through the liquidity stress rules, the 100% outflow we just talked about on the notice accounts, but indeed it's covering each individual line of your LCR to associate individual inflows or outflow percentages. It gives you the ability to put additional inflow and outflow percentages as a numeric value. One thing to note, you can set this, we can save this off as a default, but what we can also do is save off numerous versions of this same inflow and outflow percentages, which enables you to stress your LCR, to actually take it one step further in terms of what would our LCR look like if our high risk, we applied a greater percentage of outflow against those high risk or very high risk categories, and indeed against any one of those inflow or outflow percentages. So once we've assigned those inflow and outflow percentages, the last point here is around the haircuts. So again, looking at your HQLA, looking at the composition of your HQLA, and assigning them any associated haircuts. So as you can see here, there's different radio buttons which we have, which gives you the ability to apply those haircuts either at a product level, a credit rating level, a counterparty level, sector or country. And again, it's giving us the ability then to look at different haircuts depending on the different maturity, the remaining maturity of those individual elements of HQLA. We can have again the sell priority, which we use there more from the liquidity stress testing tool in terms of deciding what we sell and when we sell it. But those haircuts, once we've actually populated those, will automatically feed into your LCR report. So what I've done, we've configured the LCR, we've configured our rules, we've looked at our inflow and outflow percentages. If we actually look at the report then that has been generated, so if we go to our reports menu, first report we'll look at is the LCR. So as I maximise that then, what you're actually seeing here is the way that ALMIS auto-populates the ALMIS LCR report. As Matt alluded to before, the documentation will give you the full mappings, the coding that's required to enable population of each of these individual items. But what the ALMIS LCR report is giving us the ability to do, as you can see, is actually drill through those individual line items to look and see exactly what has been populated. So as we look at the way that our liquidity stress rule, our liquidity risk factors have been assigned now in terms of category 1, category 2, and category 3, we've got 10% outflows, which we've defined using our custom table with the custom inflow and outflow percentages. And it is basically bringing out the LCR, looking at those outflows and basically the amount of outflow that's expected within that LCR window. So throughout any line of the LCR, again, we're going to be focusing primarily on the retail here, but what you've got the ability to do is drill through any one of those lines and actually look at the composition of what makes up each individual line. And this information, this drill down information, can be copied out, pasted into Excel, and then if you want to do any secondary analysis on that. So the same LCR configuration, the same configuration that we built up for the LCR, is also populating a number of other reports. One of the reports that I particularly like here is the retail deposit report. Now the retail deposit report is breaking your retail deposits out and looking at effectively the categorization that has been assigned within the LCR. You can see here the notice given, the high risk and the very high risk factors that we've assigned through our liquidity stress rules. But what it's showing me there is the actual amount of inflow and outflow that I'm holding, that I'm generating, that I'm calculating part of those individual balances. So of our £10 million worth of retail funds that we've got within the demo set here, it's costing me, I've got to hold 1.9 million, just short of £2 million worth of liquidity against that £10 million worth of deposit. And what that should start to do is start to influence some of the decisions that are being made internally against the cost of liquidity, the cost of us holding the type of customer and product attributes that we have within the system. So we can see here, if we look at our high-risk customers, the cost of holding the liquidity against those high-risk customers, against those very high-risk customers. So again, that kind of report lends itself very, very well to your own internal transfer pricing and the pricing policy around showing the liquidity that we need to hold against those retail deposits. So again, very, very useful report. And as we mentioned, again, from the same configuration, we could look at the 47-48 report again to see the old report. Well, I say old, let's hopefully it's not going to be around for too much longer. But we have the 47-48 configuration report. We've also got the NSFR. So again, from the same configuration as we talked about before, we've used that same coding, that same configuration to build up your NSFR report, to build up your ALMM reports. What I'm going to focus on now, and I'll pass over to Gina to cover this off in a bit more detail, is looking at the C66 and the PRA 110 cash flow mismatch report. So again, from all the configuration, what we've actually done is managed to populate the ALMIS cash flow mismatch report, which, as Joe showed on the original slides at the start, the scale of the report is huge. I think we were looking at over 30,000 data points on the individual report. So we can see how we've got the maturity transformation from the details of the individual account level transactions that we have. We've got the classifications of our high risk and very high risk capital retail outflows. So we can see again how we're taking that configuration and auto popping this particular report. And as we said, taking that report one step further and actually populating the regulatory report as well. Okay, so if I can pass over to Gina, and Gina, if you can just take us through that in a bit more detail.
Thanks, Simon. I'm just going to take you through a couple of tips just on the PRA 110 auto-population. As Simon's shown here, we're showing how to get the ALMIS report, so the PRA 110. This is the C66 PRA 110 mismatch report that ALMIS produces and appears under the reports menu. How we got that was, as Simon was showing, under the update market value gap menu here, and we just tick ALMM PRA 110 and that will update that alongside the LCR and NSFR. We hadn't ticked update correct before. Now when you tick update correct, this will also map through the PRA 110 and ALMM through to the reg reporting panel within ALMIS. So it purely maps through the values through to the correct panel. And we've got the, under taxonomy 2.8, PRA 110 is here, so the latest DLL that we've got has the PRA 110 available for our reg reporting clients. When we click on edit, it brings up the PRA 110 report. Just a point on the PRA 110 report, it is a currency-based report. Here we've got a total dimension GBP. If you are only reporting one currency, so GBP, then we only want to report the total dimension to the regulator. We have had some clients who have a total and a GBP for selection when you click on the edit button for currency reports, but the regulator has in the past expressed that they only wish to see one dimension, so that's the total dimension for these cases, because it's basically just a duplicate of the same report. And I think with regards to the PRA 110, the regulator can only see the total dimension, so that's why they will request that you only submit a total.
Yeah, so if you're a single currency firm, then and you see a GBP and a total appearing, then you need to change the configuration setting so that's that right. When you go into the report, it only goes directly into the total. Yeah. So the currency dimension essentially is invisible, should be invisible to the user.
And it isn't a difficult thing to do either within ALMIS. It is purely just a setting, a toggle in the middle office. So under the file menu, there is the currency table, file, currency codes, and then material currency. So in here, I've got a number of currencies in my setup here, but for most of our clients, we'll just have a GBP pound sterling. And then you want to switch this to N for material currency. And then when you have N against GBP, it'll just show the total dimension, which is what we want. So with the PRA 110, when you are looking at how Almus has populated the PRA 110 in the reports, you do have the usual export and import methods via Excel, which are available across all of our core returns. Now, we do want to point out that for the full export of the PRA 110, due to the sheer number of data points that are actually coming out, it can take a little while to export the full template with all of the named cells. Now, this is something we'll address in a little bit more detail in part 2's webinar, when we look at bringing in specific lines of the PRA 110 that you might want to have populated outside of Almus and bring it in. We do have some hints and tips on how to make that a bit quicker and just import in specific lines of the PRA 110. However, if you're wanting just to kind of have a look generally at what Almus, the numbers that Almus has produced, you can just do a quick copy-paste of the values. So you can go into the View button for the PRA 110, and this will produce, just like all the other View buttons that we have for all the other correct returns, you can copy this to your clipboard. Thank you. So you copy, and then we have got a template here that we have made available for all of our clients. So under the handouts panel of the GoToMeeting panel, you can click on this Excel handout and download it. That will download to your downloads folder. And under the Almus report sheet there, we can just paste that in, and that is linked to that front sheet. So the front sheet is the template, basically, of the PRA 110 that the regulator has provided. So you can bring that out and view it and kind of mess around with it as you like, that top sheet, but it's just a kind of easier way to bring out the data that Almus has populated for you. So rather than, if you are just wanting to have a quick look, there is the copy-paste functionality available.
Great. Yeah, that spreadsheet there is the entire return, but we've just hidden the cells for the bits that we're not really interested in, just to make it as easy as possible to cross-reconcile the data. I think a challenge with this report is, because it's so large, is to see the wood from the trees, and the conventional Excel named cells report writer template is quite slow in Almus at the moment because of the sheer size of the data. So this is about what Georgina is showing you there is just a slicker way of getting the data in and out of the system. Okay, so there's a few tips to doing that. The next thing is points of interest. What we want to do here is show, just to run through a number of points that have come up over the while whilst we've been working with our early adopter clients and people of the C66 and so on and so forth. It's good to mention that we've got 3 or 4 of our customers have been voluntarily submitting to the PRA. So we have had some feedback from that, a little bit of feedback from that. And there's other outflows and inflows don't come from the data itself, but you put them into the the tab, the dialogue that Simon was showing for your operational expenses, etc. There is a Q&A on what to do about operational expenses, which myself I don't think has been fully thought through. One thing that PRA are wanting to do with the PRA 110 is to calculate from it stress LCRs. So they're going to sort of have an LCR calculation purely from the PRA 110. Operational expenses are deducted from, some operational expenses can be deducted from your high quality assets. So there is a sort of element of blending the weight, i.e. it's at 0%. But exactly how that's going to work, I think we still need to get some clarification on. But anyway, we are bringing in other outflows and inflows in. There is in the counterbalancing capacity section, there is an eligible collateral element. So if you have assets which are, say, pre-positioned with the central bank, but you've not drawn on them yet, so they're not encumbered assets, they're just being pre-positioned, then they do go into the counterbalancing section. And we have a method in Almas to deal with that using our auto encumbrance feature in the in the system. So within the solvency module, we have an auto encumbrance, and you can determine you can select a group of your assets which you are, say, going to be pre-positioned or could be pre-positioned. There's a little bit of, it's not exactly clear what goes into eligible collateral. Is that only pre-positioned assets, or is it wider than that? But we've got capability in Almas to identify the assets which are eligible collateral, and it will then automatically populate the counterbalancing section. Paper and own portfolio maturing was an interesting section in the 110 and the C66. I think there's been a bit more clarification on that insofar that in the consultation paper they're after more granularity for that line. So our interpretation is that conventional gilts, T-bills, certificates of deposits, all that sort of stuff that you have, negotiable instruments, I guess, should go into that line, into own paper and own portfolio maturing. It is a bit ambiguous whether that should include interest or not. We've had some discussion with the PRA on that, and whilst it's not explicit, they are suggesting that it should include interest, and that's in the general instructions. Although it is admittedly ambiguous, but for the time being, that's the steer we've had from the PRA, and we are including the interest at the moment in the way we're populating that line. We're doing automatically the interest calculations. As we know, the PRA 110 is to include interest from the data that we have. We're calculating that. We do it at a trade individual account level or trade level on the treasury side of things, working back from maturity date and based on the payment frequencies and so on and so forth at the trade level. On savings deposit products, the interest payment is determined at the product level, and so we're working on that basis, and we are assuming the interest is paid at the end of each month or each year or whatever it is. So that's just one thing that it's doing. There's a number of issues around fixed deposits or deposits generally. As you know, a fixed deposit that matures within 30 days has a risk factor if it's going to mature in 30 days. So if I have, for example, a Best Buy fixed deposit that I issued a year ago, and it's about to mature, then it has two risk criteria. It's got the Best Buy criteria, which would be 1, and the less than 30 days would be 2, so it would go into the higher outflow category. The question is, in terms of the categorization for the PRA 110, is because it's looking beyond 30 days, it's going right out to over 5 years, do you show anything that will mature within 30, eventually all fixed rate deposits mature within 30 days. So if something's got 31 days to mature, should that be a high risk outflow item or not? We kind of think not, is that, in other words, the definition is the LCR definition, but I'm sure some might disagree with that, and you could calibrate the way you calibrate the system to include all your deposits as inevitably having a high risk feature when they reach maturity. So all fixed deposits, when they get to that maturity end, there is a higher risk of withdrawal when they get to that maturity end. Obviously, they're not at that risk before they mature. Notice given, Simon mentioned that we need to split out any notice given accounts. So if you've got a notice account and you've got some balance or amount, a proportion of that the notice has been given, they need to be split out to say 2 records and so on. Some discussions on fixed ISAs. The PRA have actually clarified for purposes of LCR and so on that an ISA is deemed to be withdrawable within 30 days, so it's not to be excluded from the greater than 30. So they're contractual. The earliest contractual maturity is 30 days for a fixed ISA, regardless of its the maturity of the product, because on a conservative basis, it's the earliest withdrawal. So your fixed ISAs, some of you have fixed ISA products, the behavioural maturity can be beyond, obviously, 1 year, 2 years, whatever it is, but the earliest contractual maturity should be 30 days. Similarly, cooling off bonds, as you issue bonds, there's maybe a cooling off period. That should be identified in the product characteristic because it's got we behaviourally, or the maturity, whilst it might be a 3-year bond, customers can ask for the money back within the cooling off period. So we need to separately identify those.
And it's taken Matt's point from earlier in terms of the flexibility you've got with an ALMIS there to actually use that concatenate function on the product code to be able to add those different attributes to tell us and split accounts between the balance that has served notice and the balance that hasn't. And as well, looking at a cooling off product, so the balance which is still within the 14 days cooling off, and the balance that is beyond that, so that each of those product attributes can be treated separately.
Yeah, and there's a lot of questions around how to apply the guaranteed balance. I don't know that there's prescribed regulations on this. There's definitely a steer towards applying the guarantee to the least or the most liquid funds first, sort of an order of how liquid they are. But I don't know that there's a prescribed regulation on that.
No, we thought we'd found something that explicitly spelt out exactly what we're saying, the order of the liquidity, so how liquid the underlying deposit is. However well defined it was, there was a statement that was prefixed by saying that this does not apply to FSCS, but we still believe that's the way that we should be applying it to the least liquid first, most liquid first.
Okay, so that maybe stimulates some questions, although I can see we are running out of time. So just moving on, the roadmap for us is important for our customers, how things are moving forward. It's a busy development year with new technology coming in. The late May, we will be releasing, so very much a beta for very much early adopter Middle Office Plus clients. So that will give a lot more flexible transformation, load rules, staging area type of thing. But we'll work work with the existing ALMIS front office. Early June, there is a final version of the of the PRA 110, the final version of the PRA 110 ready for the first submission. So there is a version at the moment, but there is a list of sort of issues, a few issues. We'll be releasing our final version in early June with those issues, the known issues identified, or certainly some of them, the important ones. ones identified. 15th of August is your first submission deadline for the PRA 110. End of September, we will be releasing Reg Reporting Plus, which is our new Reg Reporting product for all new taxonomies, and for the PRA 110 version 2, you will require Reg Reporting Plus. Really, it's important for us to develop that in a new technology. It'll make it quicker. It will have some added features, like you can view the XBRL, it supports multiple submissions and regulations and so on and so forth. It's quite, well, it's extremely good sort of design and technology for coping with changing regulations and large XBRL files and so on and so forth. You will require to decide on a relational database. The two that we're supporting are Microsoft SQL Server or the open source Postgres, which is a very easy to and freely available open source database. 15th of January is the proposed date for version 2. We'll have to see from the consultation paper how if we were successful in persuading the PRA to delay that, because maybe a more sensible date to bring in version 2 of the PRA 110 would be aligned to the LCR Amending Act and Taxonomy 2.9, which is I think April 2020. There's a few known issues which are there's some known issues there which we've documented for your information, and when they're going to be fixed or not in this version. To bear in mind, it is a very large taxonomy, and our existing technology does have some elements of creaking with speed and so on and so forth. So need to bear with us whilst we develop Reg Reporting 2, or Reg Reporting Plus. Okay, well, if there are any further questions, and we've really run out of time, so we will. If there are questions, please post them, and then we can communicate a Q&A back to everyone. We are holding. This has been a very practical guide, is to help you get up and running, auto-populating the report. The second version of it will be looking a bit more at the assumption-based requirements, the behavioural flows, the monetization sections, etc. And we can have a little bit more of discussion around any interpretation issues there. To help us, Martin Harrison, who's the head of liquidity at Nationwide Building Society, has kindly agreed to sort of help us field some questions. So he'll be joining us on that part 2 webinar, where we'll deal with more interpretation points. And we're also having our webinar on interest rate risk in the banking book later on in June. So that's us about on the hour mark. So thank you very much for your attention, and we look forward to hearing from you.